Okay, guys, this is the M&A panel. We had a lot of fun with deep tech. Boy, did we have a lot of fun. And so I'm not sure what I could say that I guess there's more liberals than conservatives in San Francisco. And so I'm afraid to say anything of that nature. But I did get home safely. Although I did take two bodyguards with me. So I guess we're okay. So we did talk with both Serge and Chris on the M&A, and just coincidentally on Sunday night, I talked to a tremendous amount of people at the Baker McKinsey meeting, and I probably pumped them for like 20 hours total of M&A advice. Whether it's good or bad, we'll find out. But they did give me a lot of topics to talk about. So normally the way we do this is we take about a 2-minute introduction, and what happens is we'll talk about briefly your educational background, your professional background, and like I said last time, I said if you've got some personal stories, it's always good to give a couple personal highlights, especially if you were had something interesting like being an astronaut or a Navy SEAL or something. And one of the guys from the last panel said, well, I can trace my lineage to Moby Dick and the whaling industry. So I don't know if he lost half of his family to the whale or whether they were swimming inside the whale, but he didn't explain that. But so we'll go ahead. I think I'll go ahead and talk to you guys in order of how my screen looks. So Gabriel, Serge, and then Chris. So Gabriel, we haven't heard from you before, but you got, I guess you're a San Francisco guy with the Golden Gate there. So why don't you start it off?
Okay, well, that's the last panel. So we'll start with Serge and Chris. I'm trying to reach Gabe still.
Oh, okay. So we got, okay. So I guess we should delete him. Okay, Serge, why don't we start with you, Serge? And your home is still in good shape in Brentwood, huh?
Well, I'm in Orange County. I'm in Southern Orange County.
Oh, okay.
So,
Okay.
We are in a high risk fire zone, but we've been blessed with less winds this year, so all good. Anyway, Serge Jonnaert, tech investment banker based in Orange County. A 35-plus-year tech exec. Prior to that, held senior executive roles, both startups as well as large corporate entities, and have been involved in mergers, acquisitions, divestitures, spin-outs, you name it, in tech for many, many years. Something embarrassing to share, well, I am a child actor. I spent the first years from my 9 till my 21 on stage in musicals, and even though I grew up in Europe and have been here for 36 years, I actually performed a couple of times here in the US as well, including at the Schubert Theater and at the Lincoln Center in New York, which for all the New Yorkers in this group is definitely well known. So that's a little bit about me.
Wow, Serge, that's amazing.
Okay, Chris, I don't know. Do you think you can top that?
Probably not. Chris Anci, and I've worked for 30 plus years in financial services, both on the buy side and the sell side. And I just wrapped up a 8-year plus stint with a family office for a large real estate family in New York City. And on that thing, we were putting together some non-correlated investments for the family. On a personal note, I guess I can say that I went to Hobart College, graduated in 1990, and I was a history Soviet studies major. The Soviet studies piece was an independent major I put together myself, and I took 3 years of Russian language, interviewed with the CIA, which may or not go over well in San Fran. Did not get the job because they came back to me and said, is there anybody on this campus you do not know? Because I had a newspaper business on campus, so everybody knew my name. But yeah, and I tell my kids today, I said, you guys have to go and get a little bit of a different degree than I did, because the economy doesn't have much slack. We're a guy who basically read books and took language for 4 years, spent 30 years in financial services. So that's a little bit of a quirky story on my background.
Okay, so if you listen to my background from last year or last month, actually, I'm going to tell you, I've actually known Marty here, I think, since Justin Trudeau and Sunny Days in Canada.
I thought it was since Pierre Trudeau.
Oh, was it Pierre?
Pierre
Okay,
Trudeau.
or maybe it was Gary Trudeau. But one of the, that was when we were in school yet, when he was in. So Gary Sawka, I think I checked all the appropriate boxes, at least in some circles. USC, Harvard Business School, corporate venture capital, global transportation leasing, like containers, rail cars, ships, a few semiconductor companies, and a broker dealer, a couple of biotechs, and basically CFO most of the time. But anytime the company got to hell in the handbasket, I was the guy who was in charge of actually being the CEO or operating officer, but mostly winding it down. So that's my experience. I got a lot of M&A experience, but it's mostly in the horizontal mergers and stuff. So before we go on now, I think that, the market expectations this year, at least for the people from the legal side, they're just counting their cash register. A few of them are talking about a couple of really expensive locations like St. Bart's, where they're going to buy their house with their first M&A bonus. So I think that what I found is that the expectations for the Trump administration is, and you guys can follow up with comments, you've heard some of these, is that there'll be, for the most part, shortened timeframes for a review. Many of them may be only 30 days. And that the scrutiny, except in certain industries, really where Cyprus is involved, will be much, much shorter. So that, there may be a few things that they'll pick at, but not as much as anywhere near they had before, that there would be, though, some more scrutiny of foreign buyers, especially. And I'm just not talking about people buying farmland next to military bases or houses in overpriced places. I'm talking about, kind of more national security interests and stuff like that. So, so that's what they seem to think, that this was going to be very robust consolidation, and that I know that Chris sent me a note here in terms of the targeted industries, which they thought would be healthcare, energy, and financial services to see the most deal activity. But I think in terms of the environment, I guess I'd ask you guys, and Gabriel's still there, so he's still on there. Maybe you can delete him from the screen. But Serge, what do you think? And then Chris, what do you think about the overall expectations? Do you think they're too robust, especially with sort of the tricky interest rates, and now oil kind of getting, they're squeezing the Russians and the Iranians, so now the oil prices are going back up and stuff, and certainly drill baby drill will take a while to actually drill. So what do you think? Do you think the expectations, at least from the attorney point of view, is too robust, or do you think it's kind of just about right?
No, I think it's absolutely right. And I mean, some of the other panels had some comments on that as well. I mean, for one, pretty much since September, deal activity for most, myself including, completely dropped off the planet. And kind of post-election, there's an enthusiasm. Overall, I think the mood is an expectation of deal flow going up about 10-20% compared to 24. I've definitely seen activity level pick up literally from January 1st. People that were quiet for weeks and months all of a sudden are responding. We're engaged with prospective buyers. And I mean, I've got a lot of mandates. So if anybody's looking for good tech companies, send me an email after the conference, because there's definitely plenty of activity.
So,
Do you think
and-
that-
yeah.
Go ahead, Chris.
Oh no, I was just going to go on with that point. The momentum is definitely growing out there. Clearly, I was just in a meeting before this, and I said I don't understand what everybody does for a living that they could leave a week before Thanksgiving and show back up in January. It definitely was a ghosted period towards the end of the year, but the expectations are incredibly high for 2025. And I think some of the backdrop there is clearly the outcome of the election. I think people are expecting inflation to come down, which is obviously helps M&A, specifically for your cost of financing on those kind of deals. There's a tremendous amount of pent-up demand. I mean, the previous panel was going into it, and having spent all those years at a family office, if somebody came into a deal and I had a client say to me recently, he goes, when I invested in this thing, I was 65 years old. I'm now 72 years old. And he goes, I love my grandchildren, but I want to buy myself a boat, not them. Mm-hmm. And so the pent up demand is out there. And I think that once the momentum actually breaks, you're going to see a lot of deals, specifically in financial services, tech, media, telecom, probably industrials, and across the board too, large scale deals, mid-size and lower mid-size deals, because there needs to be a break, and we need to get the hamster wheel running again. And if memory serves me correctly, I believe that in the first Trump administration, the regulatory burden was about a $2 trillion boot off the economy's throat that he removed. And I believe that everybody's expecting that, to your point about fast tracking some deals and just letting things happen, because we've got to get, you can't have all this bureaucratic red tape. These people need liquidity, and our system runs on money flows.
So do you think in the end, will there be this wave of SPACs? A lot of, I told the story about one attorney who was bragging about all his SPACs, and when I looked at it, he found that he had only, most of them were in the 50 cent to $1 range. If they hadn't gone bankrupt, a couple were in the $2 one. And I said, you shouldn't be bragging. You should be, going to the confession booth. Do you think that there's going to be a lot of kind of junk going out, or do you think this is going to be a more moderate?
No, Serge, I'll jump in front of you. I think it's going to be some legitimate deals. I think you're going to start seeing some real consolidation. Not saying that the SPAC thing wasn't, legitimate deals, but I mean, I'm old enough to remember when they were called blank check companies. So, I mean, the whole SPAC thing was interesting, and it raised a lot of money, and it drove target companies' prices up, and it became jump balls to the point where the deals didn't consummate because the underlying asset became too expensive because everybody, was chasing those. So I don't anticipate any kind of a SPAC boom. I think you're going to see private equity finally clear the decks. I think they have a lot of aged portfolio companies that they really want to get out and return some capital to their limiteds and start reinvesting in some newer stuff, because all of these years they've been in these legacy not now quote unquote legacy companies, but subsequently in the last 5-6 years, we've got AI, we've got quantum coming, we've got some great stuff on the fintech side, and healthcare has been a desert. So the economy needs to get this liquidity back in motion.
Yeah,
okay, so
I'll piggyback on that. I mean, I was involved in one SPAC deal in the last year and a half. I mean, with SPACs, they're always going to be there, and it really comes down to managing the expectations and having the right team and execution speed as well. Because the problem is, of course, that they set an expectation, rally to raise an enormous amount of capital, but then ultimately have to go out and shop on deals that could potentially also take 12 to 18 months before they can even realize anything. And I think that's always a little bit the challenge with SPACs as well. They need to have a clear investment thesis. They almost need to have a list of targets ready to go with some, I would almost pre-negotiated concept of what the composition of the SPAC will ultimately look for. But some are successful, and some of them, yeah, absolutely. I mean, will fall apart.
Yeah, a lot of them closed because they
Yep.
didn't hit their timeline, right? So I don't know. That was crazy, candidly. Between that was definitely a tulip mania there, where everybody and their brother was launching a SPAC. I think you're going to see some consolidation, and in the consumer space, which is one area where I've focused for, not by design, but just because we ended up in it. There's a lot of the big, as we know, a lot of the big firms, they don't have, in the consumer world, they go to all the expos to go and look for new ideas, whether it's cosmetics or food or what have you, because they don't have the internal wherewithal a lot of times to follow trends. And I think there's a lot of growing brands out there that are ready for acquisition by the bigger shops, and in that space as well. I think there's going to be some movement there.
So based on your experience, though, how much top-down pressure can you put on? Because, during the last year, we saw a tremendous amount of time and money in Tapestry Capri, where we're talking about sort of mid-range handbags and, probably not, and just lots of handbag guys around, including a lot of fake ones in New York City. But why was there that much time spent on that? Kroger and Albertsons, maybe there's a little bit more pressure. They kind of did talk about price savings that they'd have. You can see U.S. Steel and Nippon maybe needed a lot of time spent, but it seems like on some of these, they just kind of gnaw at something and they just don't go away. So do you think the pressure from the top will kind of clear ones that clearly don't have really an important competitive problem?
On the consumer side?
No, on just everything.
Well, I think specifically on the consumer side, if you there's a lot of there's some beverage brands out there. There's definitely some makeup brands. Sunscreen is very, has been growing. And like I said, those companies leave because they haven't been able to raise a lot of money on that side in the last couple of years. They've reached their growth potential. They've reached the max of where they can grow, and they're probably not going to do a Series C or D or whatever in order to get into greater distribution. And this is where the larger companies that have distribution can come in and get them on the cheap, basically the relative cheap, because there's just a lot of evergreen markets for them to do. Because if one of the larger shops picks up a makeup, they can put it into full distribution in a rather short period of time. So if you're only in 3,000 doors, I mean, you can go to full distribution pretty quickly, and that's very accretive. So I think that you're going to see some movement in consumer. I also think you're going to see some movement in the oil patch as well, courtesy of the Drill Baby Drill and all the other sorts of sentiment coming out about energy policies. And you may be seeing a little bit of a pullback on the Green New Deal, and all of that money that's been going into windmills and solar and all that could be redirected into the more traditional sources of energy, because that you may see some consolidation there as well, because people are going to anticipate some growth.
Yeah.
Well, this is the year of the. Go ahead.
Yeah, Gary. I mean, another area, and that's the thing. I mean, I would say we'll probably continue to see that for the next year or so. But all the attention, of course, has been on the very big transactions driven by PE-backed big strategics, retail, manufacturing, you name it. And I agree with Chris. I mean, we'll definitely see a lot of movement in the oil and gas space. Another area, I know that we always talk about that as a different category in the real estate, but residential real estate is also seeing a lot of activity on the M&A side. So there's going to be some big pockets here where I would say the big ticket transactions is what we're going to see. I'm working more on the tech lower end of the market side, and where the fear that I'm having is, and we've talked about the deep tech panel, talked about that. Lorenzo brought this up as well, is that we talk a lot about AI, but companies aren't adopting AI fast enough, and we have. I mean, I just came back from CES. The number of companies, the level of especially vertical AI that is coming out now, robotic space, there's some really exciting stuff that, or at least companies that are creating things that will literally define our lives for the next 15, 20 years. And have gotten significant initial, like early funding, but are now kind of in that transition point where they need follow-up funding or growth funding, or need to get acquired by a strategic, to Chris's point, because they can get access to more doors. And that's an area that is going to be a struggle for the next year. And unfortunately, because there's a lot of old guys' resistance to AI in a way, especially in very traditional industries, and whereas it should be completely the opposite. They should just embrace it with open arms and look at every single thing that they could potentially use to create more efficiencies, more innovation in their companies. And we're just not seeing that just yet.
And on that point, I think I have maybe a little bit of an unorthodox outlook on where the puck is going in regards to AI. While I believe that there's going to be a handful of marquee AI companies, like an OpenAI, where people are going to know them, I've dealt with a fintech that's doing some work. I think a lot of the AI is going to be inside of Citibank, inside of UPS, inside of these big companies, that they're going to develop. They're going to use some kind of AI tools that are going to streamline things internally behind the scenes. And you may not, that particular, it's going to be proprietary AI, and you may see the gains of AI there in 5 cents or more per share, because to what Serge just said, the AI is collectively all about efficiency, and it's just going to make things much more efficient. So I think you're going to see some marquee things, a couple of brand names out there that are going to do stuff that'll be on the tip of everybody's tongue, and it's going to be really, it's going to be exciting and life-changing for the next decade. But the guts of it are going to be these. I think when you look at a UPS, I mean, AI and a UPS, I mean, that could be just, and a FedEx and stuff like that. Any kind of logistical company, they're going to create some kind of proprietary AI that's going to revolutionize their business. That's just, I kind of think that the puck is going to go there, but I could be wrong.
Yeah, I'm going to miss talking to the people. I could mainly go to my local bank and didn't have to show ID, which is kind of fun, and talk to people and stuff like that, and get to know who's coming in and out and stuff. But I don't use the ATM. I don't. It's just too impersonal. But yeah, you're right. Maybe that's like old school, but I do believe in AI, especially for these discrete tasks. But let me ask you, this is the JPM.
Hold on one second. But so I do have a little bit of a comment on that. In AI is going. I worked with a fintech that it was built by controllers in a bank, and it's going to clean up all of the control accounts inside of a bank, because before the banks can go out and offer AI everybody, they got to make sure that their data is pristine, because the AI can only work on what it has. Like when you look at the different Claude versus OpenAI, it depends on where their access to the internet is. So some have open access, which is relatively real time. Some cut it off. Some curate it a little bit. There may be a period of time too where there's some software opportunities for people to come in and go into these bigger shops, so that when you do go to the virtual assistant at a bank, as opposed to them knowing you by name, that they gotta clean their data up in order for the AI to become really efficient.
Yeah. Okay, well, we can actually revive the deep tech panel now, but I guess we gotta move on.
I had a couple of questions.
Yeah.
Yeah. So guys, can you address how M&A has changed in the recent past in terms of the deals that you look at, expectations on terms, things like that? I mean, it's remarkable how M&A has changed in the healthcare space over the last 10 to 15 years, where people are exiting at Series A or after that. I mean, whereas, it used to be a real long haul, right? Or, royalty licensing and how that's changed the game as well. So maybe you guys can address that.
Yeah, I mean, I can definitely, I'll give you an example. I just came back from CES in Las Vegas. I do this show every year. And over the years, I mean, of course, the one of the big venues is the Eureka Pavilion in the Venetian, where you have representations from all countries all over the world that are showing all their latest tech. Well, over the years, I sold 3 very early stage companies that I first met there when they were on their little 9x9 booth, kind of showing their wares for the first time. So there is definitely a drive towards getting involved with companies earlier. There's also a whole lot more scrutiny. I do feel that buyers are more knowledgeable, do take the time to do a lot more kind of preemptive analysis, and are far more selective as well. I mean, you can't just sell a company on hype anymore. It has to be something that is that can withstand a good amount of scrutiny. And in tech as well as in healthcare, it's not just the promise of doing something great anymore. You need to be able to provide all the supporting rationale, data, white papers, reports from key opinion leaders, et cetera, et cetera. So there's definitely a much higher level of scrutiny than we've ever saw before.
I agree 100%. It's no longer 10 times rev. Everybody's coming in and they're really and they're looking at recurring revenue very deeply, and they want to make sure how steady the base really is, because they're not going to I think that we started the conversation with, I think the expectations are quite high and there's a lot of pent up demand and all of that, but I do think that there may be a little bit of some valuation disappointments where people are going to have to meet in the middle. I don't think the seller's going to get the price that they want, and I think the buyer, to Serge's point, I think the buyer is going to really run through the numbers to make sure it's a real business.
Well, Bloomberg had that the PICs were coming due, and there's a lot of, it's been almost 5 years since the 0% and 1% and 2% financings. Most of them were kind of short term, just like the Treasury. I'm not sure why they didn't do a 50 or 100-year bond and join all the clubs that were doing those things, like Argentina. But there's now they have these tremendous higher interest rates. So does that make a big difference in terms of that? And that's going to reduce some of the so it seems like you have a fight with financing costs, higher financing costs, but then you have sort of inflated PEs in the public market. So there's sort of a push and pull on the valuation there.
Oh, I mean, Serge is a little bit more active than I am on the M&A side, but I'll tell you, like if you look at anybody's spreadsheet, if you take that cost of financing from 175 and you make it 4.25, that's definitely going to play a big role in the valuation, no question.
Well, we're getting the high sign here, but there was,
Maybe some questions from the audience.
Yeah, I think that some questions from the audience, and if we don't have too many, your lessons learned in terms of your managing or babysitting deals and stuff. First, let's go for a couple questions from the audience. Okay, so lessons learned, I think, in terms of your deals. I know you both brought up the fact that if it's 12 to 18 months, it's a tough issue because you have, it just drags on and on and on. It's just tired of that. But there was also managing people that kept having too high of expectations, and then you just could never meet their demands. But what kind of lessons would you give? Both of you are veterans in terms of this whole field.
Oh, I can definitely tell you, especially in tech, don't fall in love with the tech. Always, do your own due diligence as well, because I've definitely have a couple of companies that I believe hold huge potential, but they will probably be on a longer term horizon. And that's just the reality, right? Because and that goes with some of the discussions that we had on the deep tech panel as well. Lorenzo mentioned that is that AI is going to take more time to adopt, and unfortunately, we will see some companies that will not make it through the next year or so. And so be it, right? But yeah, that's just an artifact of having this massive wave of technology that is hitting us in the last 2 years.
It's massive.
Okay, one more. Chris, any lessons learned before we wrap up?
I think the lesson that everybody learned, it's not my lesson. I think that the lesson that everybody learned was you have to keep your expectations grounded. And that's one of the reasons why funds have had such a hard time raising money, because the previous panel said you could be stuck in a fund for a long time. And it's no guarantee that you're going to be taken out in a private, and then you're going to end up with people in the capital stack saying, hey, when are we getting out? What do you mean we're doing another round? So I think that everybody needs to manage expectations on exactly when this so-called liquidity event is going to happen, because it's not a fait accompli that just because you built it, they will come.
Okay, sounds like we're doing the sign off now. And this is always fun. You guys are a wealth of knowledge, and I'm sure glad that we had a nice pre-call to get to know everybody. And thank you for joining us here with your great comments. Okay.
Fantastic. Great job, guys.